So let's talk about how low rates are. They are fabulously low, and I think it is human rate nature to assume that, well, if rates are low today, they're probably going to be low tomorrow. And in fact, maybe they'll even be lower, because I just read that, the Federal Reserve is probably going to cut rates 2 more times. Didn't you just get an email? One of our people got an email from that?
Yeah. Well, the people think that rates will go lower when, in fact, it's already baked into the cake.
That's right. So these folks locked in a rate of 2.99 on a 15-year fixed, and now they're calling up our loan consultant saying, you know what, maybe we don't want to do it now because we just read that the Fed is going to cut rates 2 more times. So, they're doing the math in their head and going, well, 2.99 minus a half. I bet we'll be able to get 2.5. Thank you for playing. That's not how this works.
Yeah.
First of all, rates are low right now, not because of the Federal Reserve rate cut. That is just a coincidence. The reason why rates are low is because investors around the world are fearing a global recession, and due to mainly the trade war between America and China. And so that's why rates are low. If the Fed cuts rates 6 more times before the end of the year, that's not going to have a direct correlation to mortgage rates. It's going to be about what the expectations are for the economy. So that leads us to this Saturday's edition of the Wall Street Journal, an article by Avantika Chicote and Anna Isaac that had the headline, quote, "Some investors are betting the flight to bonds is overdone." And then it goes on in the first couple lines to say the 2019 bond rally reached epic proportions this summer. A hearty pack of skeptical investors is betting it is way overdone. Then another line from the article states, quote, "Other investors are now paring back their bets on a further drop in interest rates in the U.S. They reason that many of the risks weighing on the global economy, including trade tensions and uncertainty over Brexit, could unwind rapidly,
yes,
sending rates higher." In other words, right now, the world's money managers have all clutched their collective chests and have sold stocks. Now, they came back a little bit at the end of the week, but they've poured bazillions of dollars, like literally hundreds of millions of dollars, into interest-bearing assets called government bonds, including U.S. bonds that finished the week yielding, 1.5 something?
1.56 on the 10-year.
And it was not too many weeks ago that was at 2. All right.
Or a year ago when it was at 3.
Yeah, no, not even a year ago. Last
January,
December, the government had to pay 3. When the German government goes to borrow money right now, it's a negative yield, which challenges.
Yeah, they only have to pay like 0.25%, and then that gets overbid such that they're only trying to sell that to you for 100 cents on the dollar, but someone will pay you 104 cents on the dollar, so they pocket all of that.
That's right.
Driving down the yield to be effectively negative.
Negative 0.6, I believe, on a 10-year Bundesbond. So what does all this mean? It means, folks, take the bird in the hand, because tomorrow is not necessarily going to be like today. It could be different. It could be worse. So let's lock in the savings that are available right now.